Hello, Jen Tozser, your portfolio manager here, talking about a very difficult concept, which is risk tolerance. Now, if you're like most of my clients, the answer to risk tolerance is, Jen, I don't ever want to lose any money and I'm looking for 10% return. Sounds great, but we're not going to get it, not the way that you want. So what is risk tolerance? Risk tolerance is meant to mean how much could you potentially afford to lose over what period of time? And the concept is that different asset classes have different levels of volatility. So cash has the least amount, bonds should be second, equities should be third. And if you have therefore more equities than cash, you are going to accept more risk in your portfolio. In our industry, regulators have to give everyone a framework to work within so that we can properly explain to clients what they're getting into. Having said that, there are some issues with that basic framework. And the issues that I find with that framework is that asset classes don't always behave like you want them to. So for example, in 2008, there was as much volatility or downside in the bonds as there were in the equities. That's problematic. Today, you can get a guaranteed rate of return on your bonds, but if you want a good quality bond, like the Bank of England offered, it might be negative. So even that's a low risk tolerance because you're going to get what you asked for. The next question is that actually an investment? So when I talk about portfolios, I say you really have to look at the quality of the holdings. Yes, the regulator gives you a framework saying that this is low risk, medium, high risk, but you need to look at the quality. I could take a portfolio that's 70% bonds and 30% stock, which would be considered lower risk by a regulator, and I could put a bunch of junky bonds in there. I could put in, I'm not saying you should do this, but I could say you could buy bonds from countries like Greece or Argentina or Chile. And then in the stock part, even though it's small, I could put a bunch of junky stocks in there, such as, little mini names you've never heard of in marijuana or gold or oil and gas or tech or biotech. That still would be considered by asset class lower risk. On the other hand, you could have a portfolio that maybe doesn't have as many bonds, but has good quality stock names. So yes, risk tolerance is important, but you really need to look at the portfolio to understand, is it quality and is it something that I'm comfortable with? That should be the question. I know risk tolerance is tricky to understand, so if you have any other questions, please give me a call. Thank you.